The Federal Reserve called a meeting yesterday. Surprised on a Sunday. Not Monday, not Tuesday before the scheduled session. Sunday, March 15th, 2026. The most powerful central bank on earth, the institution that controls the cost of money for the entire global financial system, could not wait until Monday. The last time the Fed called emergency meetings with this frequency was 2020. COVID had just crashed global markets overnight. Before that, pause Lehman Brothers. The financial crisis, that is the company this Sunday meeting is keeping. And this morning, Asia opened red. Nikkei down, Hang Seng lower, Shanghai lower. The entire Asia-Pacific equity complex, which delivers the first real-time market signals every single week, opened in the red on Monday, March 16th. And while central bankers were meeting on Sundays and Asian stocks were selling off, COMEX Silver Delivery Week quietly went live. A Fed Sunday meeting, Asian markets in the red, COMEX Delivery Week active, all in the same 48 hours. This is not a normal Monday. And by the end of this video, you will understand exactly why every one of those events connects to the same point, and what that point means for silver this week. Stay in. Every section builds on the next. Let us start with the Fed, because this is where everything else originates. The FOMC has a scheduled two-day meeting this week, March 17th and 18th. The rate decision comes Wednesday at 2 p.m. Eastern. The current Fed funds rate sits at 3.5% to 3.75%. The market is pricing a 99.1% probability of no change. So the rate decision itself is not the story. The Sunday meeting is the story. The Fed holds emergency meetings when the situation cannot wait until the next scheduled date, when systemic risk is elevated, when something in the financial system is behaving in a way that requires urgent attention before markets open Monday. They met on Sunday. We do not know what they decided, but the fact that they met tells you something is being discussed that the scheduled Wednesday session was not sufficient to address. Here is the environment in which that meeting was called. Oil is at $97 per barrel. The Strait of Hormuz, which carries roughly 21% of the world's daily oil supply, has been functionally blocked since March 2nd. The IEA has already called on G7 nations to release strategic reserves just to stabilize markets. The U.S. announced the largest single SPR release in American history, 172 million barrels, and oil is still near $100. The largest strategic reserve release in U.S. history did not break the oil price. That is the environment the Fed walked into on Sunday. A central bank facing war-driven inflation on one side and financial system stress on the other has no clean options. It cannot cut rates into $97 oil without losing credibility on price stability. It cannot raise rates into a war-driven economic slowdown without accelerating the deterioration. And it cannot stand still indefinitely while the system shows signs of stress that required a Sunday meeting to address. Watch Wednesday's FOMC statement with full precision. Specifically, watch for three phrases: supply shock, transitory inflation, liquidity conditions. If Powell uses language that frames this inflation as war-driven and temporary, that opens a rate cut pathway. A rate cut pathway means a weaker dollar, and a weaker dollar is the most direct short-term catalyst available for silver above $85. When Asia opens on Monday morning, it delivers the first real-time market reaction to everything that happened over the weekend. Before New York opens, before London opens, Asia goes first. This morning, Japan's Nikkei opened at 53,138 against a previous close of 53,119, down at the open. 2 straight weeks of declines under the weight of the Iran war and elevated oil. Japan imports nearly 100% of its oil. When oil sits at $97, Japan's manufacturers, exporters, and logistics sector all face rising input costs simultaneously. That hits corporate earnings. That hits the index. Hong Kong's Hang Seng opened lower. Hang Seng futures had been pricing in a lower open before the bell rang. The entire Asia-Pacific complex opened red on the same Monday that COMEX Delivery Week went live. Euronews published this morning, and this headline is worth reading carefully. Markets may be underestimating how damaging the Iran war could become for the global economy if the conflict drags on longer than investors expect. Fortune published 2 days ago. Peak war panic will likely hit financial markets in 1 to 3 weeks. We are now inside that window. When Asian equities sell off, institutional capital needs somewhere to go. Some of it flows into the US dollar. That is why silver is under short-term paper pressure today. But a portion of that capital, the portion managed by investors who understand what is happening at COMEX right now, is rotating into physical precious metals, not paper silver, physical metal. And that distinction is the most important thing in this entire video. Let us go inside the COMEX delivery cycle, because this is where the structural story lives, and the numbers here are unlike anything seen in modern silver market history. At the start of this delivery cycle, COMEX had 86.13 million ounces of silver in its registered inventory. Registered means specifically designated as available for physical delivery against futures contracts, not eligible, which just sits in a vault and cannot be used for delivery. Registered, available, 86.13 million ounces. On first notice day, 10,526 contracts filed for physical delivery. Each contract is 5,000 ounces. That is 52.63 million ounces of physical silver being demanded from COMEX registered inventory in a single delivery cycle. 52.63 million ounces against 86.13 million ounces of supply. 61% of the entire registered inventory being tested in 1 month. In a normal delivery month, 2% to 5% of contracts stand for physical delivery. 4 to 8 million ounces in a strong month. 52.63 million ounces is not a strong month. This is the most aggressive delivery demand COMEX has seen in modern memory, and now the number that makes the arithmetic acute. 74.38 million ounces have already been delivered so far in this cycle, and there is still demand outstanding. Read that again. Started with 86 million ounces, delivered 74 million, demand still coming. The math here is not comfortable for COMEX. If you started with 86 million ounces, delivered 74 million, and demand is still arriving, you are running out of room very fast. Now here's what happened when the market felt that pressure in real time. On first notice day, silver spiked to $90.10 per ounce intraday. That was physical delivery demand pushing the paper price up, because when real buyers want real metal, the paper price has to reflect that reality. And then COMEX circuit breakers activated, the price crashed back to 80.57s. A confirmed news source reported, spot silver closes at 80.57 after 4% crash amid COMEX glitches. COMEX glitches. In a normal delivery month, COMEX does not glitch. An exchange that activates circuit breakers and experiences operational glitches during a delivery cycle where 61% of its registered inventory is being demanded is an exchange operating under stress it was not designed to handle. CME Group responded by raising margin requirements on silver futures. Initial margin moved from roughly 11% of contract value to 15% to 18%. The explicit purpose, shake out leverage longs, force speculative buyers to close positions, reduce delivery pressure on the exchange. But here is what margin hikes cannot stop. They cannot stop entities that actually want physical silver. The 10,526 contracts standing for delivery are not leverage plays. These are entities with the capital and the intent to take physical metal. Raising margins does not change their mind. And delivery notices are still coming. As of Thursday last week, 511 delivery notices were issued in a single day. March silver deliveries passed 32 million ounces total. Scotiabank issued 249 notices. BNP Paribas stopped 255. These are not retail investors. These are global banks, institutions managing hundreds of millions of dollars in physical commodity exposure, using COMEX exactly as it was designed to take delivery of physical silver. Now the JP Morgan layer. On March 10th, JP Morgan moved 169 million ounces of silver out of COMEX deliverable vaults into non-deliverable storage. Non-deliverable means that silver cannot be used to satisfy COMEX delivery contracts. It belongs to JP Morgan. It is not going anywhere. On March 12th, JP Morgan bought an additional 18 million ounces of physical silver at market prices of approximately $84 to $85 per ounce. Today, silver is at 80.47. That means JP Morgan is currently sitting on a paper loss of roughly $4 per ounce on that 18 million ounce purchase. Approximately $72 million in unrealized losses. Does JP Morgan make $72 million mistakes on a physical silver accumulation play they planned weeks in advance? JP Morgan's current total physical silver holdings exceed 750 million ounces. Global annual silver mine production is approximately 820 million ounces per year. JP Morgan is sitting on nearly 1 full year of global silver supply. That is the institution currently sitting on a $72 million paper loss and not selling. There are 2 prices for silver right now. The COMEX paper price, currently 80.47, Shanghai physical silver, trading at a premium of $10 to $12 per ounce above COMEX. In a functioning arbitrage market, that gap closes automatically. Traders buy cheap silver on COMEX, Take delivery, ship it to Shanghai, sell at the premium, pocket the difference. Basic commodity arbitrage. It works 99% of the time. When it stops working, it means one of two things. Either there is not enough physical silver available on COMEX to run the arbitrage, which is exactly what the 86 million ounce inventory situation and the 74 million ounce delivery figure confirms, or the cost and complexity of taking delivery and moving metal has become so prohibitive that the trade is not executable at scale. Either explanation is bullish for physical silver. Either explanation tells you the paper price is not reflecting physical reality. The relative value picture reinforces everything the delivery data is showing. Gold is at 5,018s today. Silver is at 80.47s. Gold to silver ratio, 62.4 to 1. JP Morgan's own research published in February 2026 noted directly that the ratio is as close as it has been in 15 years as both metals undergo extreme volatility to start 2026. The historical context around that 62.4 figure is worth understanding precisely. In 1980, when silver peaked during the Hunt Brothers episode, the ratio was approximately 15 to 1. In 2011, when silver hit its second all-time high, the ratio compressed to 32 to 1. The long-term historical average sits around 47 to 1. We are at 62.4 to 1 right now. The ratio compression math is not a prediction, it is arithmetic. If the ratio returns to 47, the long-term average with gold holding at $5,018, silver needs to be at 106 per ounce. That is a 32% move from today's price. Without assuming any delivery default, without assuming any new geopolitical shock, just a return to the long-term historical average, if the ratio compresses to 40, where it has been multiple times in modern history, silver at that ratio is $125. If the ratio goes to 32, the 2011 level with gold at $5,000, silver is $156. These are not predictions. These are the mathematics of where silver has traded relative to gold before, applied to where gold is trading today. Here is where the Iran situation stands as of today. Iran's foreign minister stated publicly on March 15th, yesterday, "We never asked for a ceasefire." BBC confirmed. NPR confirmed. Two separate outlets. One clear statement. Israel told its allies this week it still has thousands of targets in Iran. Trump spent the weekend calling 7 countries to send warships to help reopen the Strait of Hormuz, confirmed by Axios on March 14th. Hormuz experts are stating it could take weeks to restore full commercial shipping traffic even if a ceasefire began today. Weeks. With oil at $97, drone attacks on UAE oil facilities were reported Sunday. Al Jazeera confirmed fire at Dubai airport following a drone attack. Dubai Airport is the world's busiest international airport. It handles global electronics, solar panels, industrial components, all products that consume silver. The war has now reached civilian commercial infrastructure. The U.S. has spent $12 billion on the Iran war in the first 16 days. $12 billion in 16 days. And the conflict shows no sign of ending. Robinhood prediction markets are currently pricing WTI oil above $100 this week at 97% probability. The geopolitical pressure on this market is not easing, it is expanding in scope. The bear case is real and deserves full precision. The dollar above 100 on the DXY remains the primary headwind for paper metals. Safe haven dollar demand from Asian equity selling creates mechanical downward pressure on silver's paper price independent of any physical market dynamic. CME margin increases from 11% to 15% to 18% are designed specifically to shake out leveraged holders. If they succeed in forcing additional liquidations before Wednesday, silver tests $78 and potentially lower before the Fed decision provides directional clarity. The COMEX delivery math is acute, but an exchange under stress has tools beyond margin hikes, emergency cash settlement provisions, delivery deferrals, position limits. Regulatory intervention is a real possibility in a delivery cycle this extreme. Any of those interventions could temporarily relieve the delivery pressure without resolving the underlying supply reality. If the Fed Wednesday statement surprises to the hawkish side, if the dot plot eliminates cuts and any FOMC member advocates for a potential hike, silver drops $1.0 to $2.50 in the first 15 minutes as dollar strength accelerates. The structural case is the strongest it has been in this entire cycle. That does not prevent the paper price from moving lower before Wednesday's resolution. Size accordingly. Here is what to watch through Wednesday and beyond. Watch Wednesday's FOMC language specifically. Not the rate decision that is already priced at 99.1% unchanged. Watch for supply shock, transitory inflation, and liquidity conditions in Powell's language. Any of those phrases signals a rate cut pathway. A rate cut pathway weakens the dollar. A weaker dollar from 100 is the strongest short-term paper silver catalyst available. Watch daily COMEX delivery notices published each morning. The critical threshold is 200 notices per day. If delivery notices stay above 200, the inventory stress is real and ongoing. If notices collapse below 200, the squeeze is being absorbed through cash settlements. Watch COMEX registered inventory daily. The critical level is 80 million ounces. If registered inventory drops below 80 million with delivery demand still outstanding, that is the moment the arithmetic becomes impossible to manage quietly. Watch the gold to silver ratio. Any move from the current 62.4 towards 60, then 58, then 55 is the signal of capital rotating specifically into silver. Not precious metals broadly, silver specifically. Watch WTI oil. If oil moves back above $100, dollar safe haven demand continues to pressure the paper price. But the physical market diverges further from COMEX simultaneously. Both directions in oil create a more extreme paper-to-physical divergence. Understanding that dynamic is the difference between reacting to the paper price and reading the physical market correctly. Here is the complete picture as it stands this Monday morning. The Federal Reserve called a Sunday meeting. The last time that happened with this frequency was 2020 and 2008. Asia opened red across every major index simultaneously. COMEX delivery week is live, with 52.63 million ounces demanded in a single cycle against 86.13 million ounces registered. 74.38 million ounces already delivered, with demand still outstanding. COMEX circuit breakers activated when the paper price tried to reflect the physical pressure. CME raised margin requirements to force out leveraged longs. Scotiabank and BNP Paribas are still issuing and stopping hundreds of delivery notices per day. JP Morgan is sitting on a $72 million paper loss on 18 million ounces and not selling. Shanghai is paying $10 to $12 more per ounce than COMEX for the same metal. Arbitrage that should close that gap is not closing it. And the Fed meets Wednesday with language that could either open a rate cut pathway or slam it shut. There are two prices for silver right now. The COMEX paper price at $80.47, managed by dollar strength, margin hikes, circuit breakers, and institutional mechanics. And the physical price, Shanghai paying $90 to $92, driven by real demand from entities that need real metal and are signing delivery notices to prove it. These two prices cannot stay disconnected forever. Either the physical price comes down, which requires the supply squeeze to ease, which requires COMEX inventory to stabilize, which requires delivery demand to drop, which requires Scotiabank and BNP and every other institution filing notices to stop wanting metal, or the paper price goes up to meet the physical price. One of those two things will happen. The math demands it. The Fed met on a Sunday. Asia opened red. COMEX delivery week is live. JP Morgan is sitting on a paper loss and not moving. Watch the registered inventory number daily. Watch Wednesday's language. Watch the delivery notices every morning. Verify every number in this video. COMEX delivery notices and registered inventory are public and updated daily. FOMC statements are published in full at 2 p.m. Eastern Wednesday. Fed rate probability tables are live on CME FedWatch. Iran foreign minister statements are confirmed by BBC and NPR, on public record. Scotiabank and BNP Paribas delivery data is published through CME Group filings. The data is public. The mechanics are understandable. The only requirement is the discipline to read the physical market as clearly as you read the paper price, and to understand that when they diverge this sharply, one of them is wrong. The $10 to $12 gap between Shanghai and New York will close. The only question is which direction. Invest with logic, not hype. Market Crux. Signing off. Market Crux. All data independently verifiable. Not financial advice.